Welcome to Module 2.5, where we'll look into risk management, a crucial aspect of crypto investing and trading. Risk management entails predicting and identifying the financial risks involved with your investments and minimizing them by employing a set of strategies. There are numerous risk management strategies that investors can employ to minimize loss while working towards their financial goals. This includes staying up to date with regulations and crypto news, diversifying your portfolio, and using advanced order types to avoid losing a large portion of your capital. Let's start by exploring regulatory risk. There are significant risks stemming from uncertainties or changes in the laws, rules, and regulations associated with cryptocurrencies. Each jurisdiction has vastly different rules, and it can be hard to figure out which laws you need to comply with. You may be wondering if this is still a significant risk if you live in a crypto-friendly jurisdiction. Well, any changes in the laws of other countries can dramatically impact the value or legality of a cryptocurrency. So, what can you do to manage regulatory risks? First, you need to understand the regulatory landscape in your home country as well as the overall regulatory environment internationally. This can include knowing if certain activities are legal or illegal, how cryptocurrencies are taxed, and what responsibilities you have as an investor. Second, you need to stay updated about any changes in regulations around crypto. Make sure to regularly check updates from financial authorities, news websites, and crypto-specific resources to stay informed. Keeping up to date with regulatory news isn't a one-and-done task. This does take time and needs to be done as long as you are invested in crypto. You can also diversify your investments across different cryptocurrencies to minimize your exposure to this risk. Legal advice is also helpful, as legal professionals or financial advisors can provide advice tailored to your specific situation. Lastly, be prepared for any regulatory changes. Always have a plan B, such as setting aside money for potential tax liabilities or having a plan to sell certain assets if their legal status changes. Once you have a better understanding of crypto regulation and created a plan to manage this risk, you'll need to start thinking about your exposure to market risk, operational risk, liquidity risk, and security risk. Market risk refers to the inherent risks of the volatile crypto market and price fluctuations. Operational risk covers issues such as platform or infrastructure failures. Liquidity risk refers to the convertibility of certain cryptocurrencies into cash quickly, and security risk stems from cyber attacks, scams, and fraud. There are other risks such as credit risk, systemic risk, counterparty risk, and more. What can you do about all these risks? The good thing is that there are many risk management strategies you can employ to help keep your risk exposure at a reasonable level. Let's look at a few popular strategies. Diversifying your portfolio is one of the most popular fundamental tools to reduce your overall investment risk. You can hold a variety of different coins and tokens, keep each position at an appropriate size, and constantly rebalance the portfolio so you won't be too heavily invested in any one asset. This can minimize the chance of oversized losses. You can also hedge your holdings, which means taking a position in a related asset that is expected to move in the opposite direction of the primary position. The purpose is to offset potential losses. If you own $10,000 worth of Bitcoin and want to hedge against a possible decrease in its price, you could buy a put option for a premium of $500 that gives you the right to sell Bitcoin at $50,000 at a future date. If Bitcoin's price falls to $40,000, you can exercise your option and sell your Bitcoin for $50,000, significantly reducing your losses. Next, you can utilize advanced order types to lock in profits or protect yourself from losses. As we've learned in the last module, stop-loss orders allow traders to limit losses when a trade goes wrong. Take profit orders ensure that you lock in profits when a trade goes well. These trading tools can be very helpful to manage your investment risks. Another strategy is the 1% rule, where you don't risk any amount more than 1% of your total capital on a single position. For instance, If you have $10,000 to invest and want to adhere to the 1% rule, you could buy $10,000 of Bitcoin and set a stop-loss order to sell at $9,900. This way, you would limit your losses to 1% of your total investment capital. It's always a good idea to plan for the worst. So having an exit strategy is an essential way to manage your risks. It's easy for us to get caught up in a bull market and its euphoria, but having a plan to exit your position can help lock in gains. One way is to use limit orders to take profit or place a floor on maximum loss that you can stand. As a general rule of thumb, once you have your exit plan, you should stick to it. Finally, it's essential to emphasize the importance of do your own research. This principle is so vital within the crypto community that it's commonly referred to by its acronym DYOR. Before investing in a token, coin, project, or other asset, you must do your due diligence. It's key that you assess essential information about an asset to fully understand its risks. If you want to invest in an ICO, ensure you read the white paper and understand the tokenomics, roadmap, and communities before you make the jump. In summary, investing in crypto can be risky, but there are many ways you can manage those risks. At the end of the day, it comes down to doing your own research, studying to continuously improve, and being disciplined with your investment strategies. This concludes the final module in Section 2. In the next section, we'll take a deep dive into the world of Bitcoin, the largest and the most prominent cryptocurrency.